morning to our wonderful audience and welcome back to Boutiques on Wednesdays. As central banks continue their fight against inflation and draining liquidity from the system, we've seen a few more cracks appearing in the past few weeks, especially in the banking sector with the likes of SVB and Credit Suisse, much talked about and much explained about. The yield curve is still deeply inverted across the developed world, signaling that we are moving into a recessionary environment. However, some think that the Fed may pause to ensure financial stability and maybe pivot before the end of the year. But I have to remind you that central banks normally only pivot if something in the system breaks, so not necessarily a good thing. To call macro events are futile, and is it not then more pragmatic to invest in a sensible fund manager with the ability to find good companies and sometimes trading at a discount with recent or decent return on equity? It is our absolute privilege to introduce a new member to the BCI family, Ranmore Fund Management, with the launch of the BCI Ranmore Global Equity Value Feeder Fund. Joining us today is the founder of Ranmore, Sean Pesh. Sean, thank you so much for joining us today. It's an absolute privilege to have you with us. We know you're normally in London, but you are in Cape Town today, so visiting our wonderful country, and you're also attending the Morningstar Awards tonight. So, Sean, thank you so much for joining us. And maybe just from my side, I know you are very different to the rest. And maybe to quote you is that you are value investors buying what makes sense. And not to steal your thunder, but if I look at your performance numbers as at the end of Feb 2023, you significantly outperform the MSCI over any period, and you are mostly top quartile performances. As an introductory presentation to this audience, we are very keen to get more insight into your business, into Ranmore, and exactly how you do that. Thank you, Sean.
Eugene, thank you very much for that warm introduction, and it's certainly great to be here, and thank you for this opportunity. And I'm looking forward to the questions. It's an interesting time out there in the markets. Of course, there's always opportunities, and so look forward to those. So just in terms of sharing my screen here, right, and then we'll crack on. But thank you, Eugene. I'm going to assume everything's all good there, right? Okie dokes.
Perfect, thanks.
Perfect. So briefly, who are we? We're a boutique UK value fund manager. We've been going in the UK since 2008. We're obviously regulated by the FCA, and we're intensely focused. Okay, we focused on one fund, which is an Irish UCITS. It's a highly regulated offshore fund. UCITS structure is extremely well known, as we all know, and we have one team only focused on that fund. It's a small team. You know, I want to manage money. I don't want to manage people, especially not difficult people. There are many difficult people in our industry, and we're heavily supported by technology, and that is what we do. And we're very excited to now be on the BCI platform with our Global Equity Value Feeder Fund. Okay, so why Ranmore? Well, the first point is we experienced decision makers. We've been at this for a long time. Many of you will be familiar with Andrew Lapping, who I convinced to come out of retirement a year and a bit ago. Andrew and I worked closely together when I was at Orbis. You can see from my history there, I started at Old Mutual Asset Managers, worked at Decillion, where we ran a hedge fund, spent some time at Orbis. And Andrew was the Chief Investment Officer at Alan Gray. We've been friends. He's had money in our fund for a long time, and we both sing from the same song sheet. We've both been around the block. Interestingly, there's not that many international fund managers out there, I would argue, who have been around and invested during inflationary times. You know, inflation internationally has not been a function. We grew up investing in inflationary times. So we ably assisted by a few other analysts who've also been with us for a long time. And so that's the first reason. We just try and invest like astute business people. And I think this is what we do. And you might think, well, doesn't everybody do that? But arguably not. There's so many other factors. The fear of underperforming a benchmark comes into play so often in our industry. But we ignore that, and we just invest like astute business people. And many of our the advisor clients are astute business people. And if you ask them, what do you do? Well, we look for businesses with great cash flow. Well, that's what we do. We want management to be on our side. It's no good just to say we want good management. We want management on our side. Elon Musk is arguably a very good manager. I mean, he's built these businesses from the ground up, but he does take extreme and excessive, we would argue, remuneration in the form of share options and all the rest. And so we want management on our side to be doing sensible deals and managing the business with shareholders in mind. We want to buy mispriced assets. And when you buy a mispriced asset, it means you have a margin of safety. And let me give you an example. And we always want to know, why is this asset mispriced? So let's pretend you wanted to buy a BMW convertible. And if you wanted to go and buy that BMW convertible at the beginning of summer, on a Saturday morning when you walked into the showroom, you're not going to get a good deal. If you wanted to buy that BMW convertible close to a quarter end in the middle of winter on a rainy Tuesday night, you're probably going to get a good deal. Okay, so the end result is you're still going to get a BMW convertible. The only difference is you have to wait 6 months until summer. And so that's what we want to do. We want to know, why is this business mispriced? If we buy a mispriced asset, okay, it gives you a margin of safety. If we get it wrong, and that's the next point, we are not going to get every investment correct. Okay, if we get 6 or 7 out of 10 right, but we don't lose too much on the 3 we get wrong, well, then we will do well. But we want to speak the truth. We always reevaluating our investments, saying, have we got this wrong? Have we got European banks wrong? And we will go in and look at that. And so we try and speak the truth to ourselves and obviously to our clients. And that's the first part, is to tell our clients we're not going to get it all right. Okay? No, even if you're the greatest barrister or advocate in the world, you're not going to win every case. If you're the best tennis player in the world, you're not going to hit every ball in. You're going to hit some balls into the net, etc. The key is, when you get it wrong, be honest about it to yourself and make sure you don't lose too much money. And we're going to ignore the benchmark. We will invest in a company only if it ticks those boxes above and it makes sense. We all want great businesses and great quality businesses and great growing businesses, but you can pay too much for them, in the same way as you can pay too much for a great footballer. So we've got to be careful about overpaying. A BMW is a great car, a Mercedes is a great car. You don't want to pay 5 million rand for them. So that's the thing. So how have we done? Well, here's the long-term track record. We, the green line, the MSCI World Index is the yellow, and the peers is the purple line. And you can see that we were ahead of the MSCI, of our benchmark, until sort of late 2018. And then what happened? Interest rates collapsed and fell. All of a sudden, everybody wanted growing quality businesses, and we just didn't participate in buying Zoom and Peloton and Tesla and some of those things that just ran to the moon. Of course, when reality dawned and those things fell back to earth, well, our portfolio outperformed. Okay, and again, but what's important is, especially if we think about the current situation, the concerns over whether we going into a recessionary environment, what's going to happen to the oil price, what's going to happen to interest rates, a couple of important points. So we started in the late 2008, the tailwind of the global financial crisis. Through our period, we've had the global financial crisis, the European crisis, Fukushima, which affected Japan, record low negative oil prices, high oil prices, pandemic, and yet we've still taken $100 to $400. Okay, and how does that rank in terms of our peers? Well, this is up to the end of Feb. First percentile over 1 year, 2 years, second percentile over 3 years, and third percentile since we started. And we've just done that by investing in companies at a time we thought makes sense. How does that compare in terms of rands? Well, given the rand weakness over that period, 100 rand is today 775 rand, and so that's compounded at 15% per annum after all fees, and the MSCI 14.6 and the large cap blend equity 12%. So again, that's just the previous numbers in rand terms. Now, what's important, and this is probably the key takeaway that I want you to get from this presentation, this is the relative, which is the one price divided by the other price. Okay, so it's the price of the MSCI Value Index divided by the MSCI World Index. And when the line is going up, sloping up, value is outperforming. When the line is sloping down, value is underperforming. Now, we have generated that performance, even though we're value managers, at a time when you can see that value has underperformed, right? So you know, say what you want. We are not value managers who we think will only outperform if value outperforms. I mean, we almost kept up even though value substantially underperformed. And why did value substantially underperform? Well, you know, we had after a big move, when value underperformed for a long time, how do we think people are positioned? Well, we know they are all positioned in the same way. And today, people are long or overweight passive funds. They're overweight the US, they're overweight large cap companies, and they're overweight growth. And when you look at the fact sheets of many funds out there, you know and you recognize all the names, which is quite interesting because if you think, well, all the thousands of opportunities out there, how can we as individual investors or average individual investor recognize all these names? Surely there are other companies that are, exciting opportunities that people don't know. And today, people are underweight active managers in companies outside the US, mid and small cap and value. And when we talk about small cap in international terms, we're talking about companies that are worth billions and billions of dollars, even though they're small cap. A $3 or $4 billion company is a small cap in international terms. But now so everybody's positioned in the same way because value has underperformed for so long. Nobody wanted value, all right? And then the world turned upside down with the pandemic and then the war. We went from low inflation to high inflation. We went from low interest rates to high interest rates. Offshoring to onshoring. What does that mean? Well, we used to want to get everything manufactured in Asia, but then with our medical equipment, with the pandemic, it's like, well, let's get the medical equipment over. We can't. The airplanes aren't flying. So it's a real risk, especially with what's going on with China siding with Russia, and companies now want to bring the manufacturing onshore. What does that do? Raises price. Okay, and we've gone from global stability to global instability. Now, you can imagine that if value underperformed in the old environment of low inflation, low interest rates, it should be and now we've got the completely opposite environment. It should be no surprise that value is now outperforming. Okay, and that is the key thing, and that is why one of the reasons why you see we have rallied sharply, and the wind has changed direction. So when one looks at investment performance over certain periods, I would encourage people to say, well, if that return was, what environment was that return generated in? Is the environment going forward likely to be similar to that when that performance was generated? But the real problem today, given that everybody is positioned like that, is earnings for large US growth companies falling. This is the earnings per share, the 5-year compound growth rate of Apple, Microsoft, and NVIDIA. I've just taken 3 companies out of the MSCI growth top 10. And you can see, there we go, fantastic growth over the last 5 years. What about the latest year, latest 4 quarters? Well, Apple's earnings are down 2%, and Microsoft's are only up 3%, and NVIDIA's are down 25%, even with all this AI. Okay, well, what about the latest quarter? We're trying to drill down and see, is there a change in trend? Is the wind changing direction? Well, in the latest quarter, compared to 4 quarters ago, Apple's earnings were down 10%, Microsoft's earnings are down 6%. NVIDIA down 33. Okay, what do broker analysts out there think earnings are going to grow over the next 2 years? Well, no, it's all going to rebound. 7%, 13%, 32%. Okay, and how much are we paying for that? We're paying 27 times earnings, 28 times earnings, 77 times earnings. Okay, and this is the number of broker analysts out there doing the research. Now, the question I would have for investors is, what happens if that growth expected growth doesn't materialize? And if it doesn't materialize, there's going to be a lot of downside. So that is one of the problems. We're coming up to quarter end. It's a tough environment. When Silicon Valley falls over, many of their clients are startup technology companies. Those startup technology companies are using Microsoft products, are advertising on Alphabet, etc. Okay, so let's take 3 of our companies that we have in our top 10. We've got Petrobras, which is a Brazilian oil company, Sanmina, which is probably a company you've never heard of, and we can talk about it in a sec, and Foot Locker, which actually had Investor Day the other day. So that's what they have grown at, compound over the last 5 years. And the first thing you might say to yourself is, oh, I thought value managers only bought boring companies that don't grow. No, of course we don't. We just don't want to pay too much for the growth. How has that earnings growth been over the last year? 114%, 38%, minus 25%. Now, why did Foot Locker's earnings, why were they under pressure? Because what's happened is, so they sell, it's a shoe chain of Nike and all the brands, Mizuno and Saucony and Hoka and On Running, etc. It's a chain of some 3,000 stores, mainly in the US. And of course, because the shipping container costs were high, that is all filtering through at the moment. All right. What about the latest quarter? Petrobras's earnings were up 83%, Sanmina's 52%, and Foot Locker was down 34% for the same reason. What is the expected growth for some broker analysts over the next 2 years? Minus 20 for Petrobras, plus 9 for Sanmina, and no growth expected for Foot Locker. Okay, now the first point I want to point out is look at the trend in Sanmina. It's the complete opposite. Over 5 years, they grew 17%, then they grew 38%, and the latest quarter 52%. Why? Because they're a beneficiary of onshoring. They set up assembly plants in countries, and so they are a beneficiary of that. But analysts' expectations are not high. And we're only paying 2 times earnings, 10 times earnings, and 8 times earnings. So you can kind of see that we're not paying for, we think that that earnings growth for those companies is going to be higher. But we're not paying for it because of the low multiple. And you can see that you've only got three analysts following, there's actually 6 analysts following Sanmina, not 56. So where is an undiscovered jewel? It's likely to be in those. And that is the point. The point is that small funds, boutiques, can't buy Sanmina. So for example, if we're running $1 billion fund and you wanted a 3% position in Sanmina, that means you want a $30 million position. All right. If you're running a $20 billion fund, you need a $600 million position in Sanmina. Well, the problem is Sanmina only trades $30 million a day. And if you are 10% of that trade, it means you can only buy $3 million worth of Sanmina shares a day. It will take you 10 days as a $1 billion fund. It'll take you 200 days for a $20 billion fund. And if you look at that for Microsoft, you need Microsoft's value of Microsoft's shares that trade every day is $7.8 billion. And so if you want a 3% position or $600 million position in a $20 billion fund, it'll take you less than a day. And so as a result, the small companies are out of the scope of the large funds. Okay, even if they're very attractive, the large funds can't reposition. All right, so we are very different to our peers. We're able to buy exciting companies like Sanmina, like Foot Locker, and we're not paying a high price for that. And that's doing that over and over is how we've been able to generate performance. And you can see that the PE ratio of our fund is under 7, which is half the value of the world index. And our dividend yield is much higher and price to book is far lower. And so we think that we're buying those companies at great prices. Now, because of that, we have a very different looking portfolio to the world index. So whereas the world index now has nearly 70% in US companies, North American companies, we have less than 20. We have more in Europe and far more than the benchmark, and in Japan. And we find great companies in Europe and great companies in Japan that are still growing. They might be listed in Europe and listed in Japan, but not all their business operations are taking place there, and they're able to benefit around the world. And so if you look at our top 10, some of the names you'll recognize and some you won't. Some of these European banks, Santander, SocGen, Sanmina. We've got US food retailers, Kroger and Albertsons. We've got Heidelberg Cement, which is the Heidelberg in Germany, and it's not the Heidelberg in South Africa. So you want to look at top 10s and go, well, I don't know these companies because, well, that's our job to go and find them and to find out whether they offer attractive value. So really, in summary, why Ranmore? Well, our process has delivered top quartile returns over the long term and over many economic cycles. We are able to capitalize on the fantastic value in smaller companies. We do invest with a margin of safety, and that is crucial in the current environment. It is volatile out there, and we have a high active share of some 99%. So that means that you are not getting with us the same thing that you can get with a passive fund. Obviously, we don't charge performance fees, and as we grow, our base fee will fall. Okay, why now? Opportunities created by fear are perishable. There's some fantastic opportunities. This is not the European crisis that we saw back in 2011. It's very different, and so we're excited. Right, so Eugene, with that, happy to take any questions.
Sean, thank you so much for that. Good insight to your business, and makes a lot of sense. Maybe a couple of questions from my side. We all understand Siegel's paradox, and in short, for that example, if you lose 30% of capital, you need 25% gains to get back to the diminished value. I think the trick is then to ask, how do you minimize drawdowns in your fund?
How do we minimize drawdowns in our fund? Well, sometimes those drawdowns are for valid reasons. So, for example, let's say, and so we obviously try and weight our positions. Okay, so we don't have, our biggest position is sort of around 5%. We're allowed to go up to 10, but we don't go anywhere close to that. We're at, it's about 6% at the moment. And the drawdowns, it's interesting. We're looking at how do we remove the risk of a permanent loss of capital. And how do we do that? We focus on companies that have got strong balance sheets. Right now, that is absolutely critical. Okay, you must have companies with strong balance sheets and lots of liquidity. If there's a drawdown because other investors are running scared of European banks, we look to take advantage of that. Those drawdowns might be, I think, as I write here, we're up nearly 8% year to date in dollars. Okay, and this month with all that's going on and European exposure, we're down 1.5%, which is 1.6% or whatever it is, month to date. Yesterday, one of our positions, I think it's like position number 12, got bought out at a 50% premium. So the share price went up 14%. Okay, so and that's the beautiful thing as a value investor. Sometimes we'd all love to be in a fund that would only trickle up 1% a month, but that's what happened to Madoff. We know that investing out there, that's not going to be like that. So how do we try and minimize the drawdowns? We try and have decent position sizes. We reestablish, we re-look at any time, if there's something that's going wrong, we say, have we got this wrong? We went and looked at all that, for example, recently, we looked at all these European banks again. They have got high levels of liquidity. They've got lots of cash. They are not exposed to what's going on in the US. The US, they've had 3 banks go bankrupt. We don't have any US banks in the portfolio. Okay, they've had 3 banks in the last week. There are no European banks. Credit Suisse is a Swiss bank. It's not regulated by the ECB. And the ECB, interestingly, raised rates 50 basis points last week. They wouldn't have done so if they thought that jeopardized their banking system. So Europe is highly regulated. The banks have lots of cash on deposit, and they've been conservatively managed. And so, so position sizes is quite important. And that's pretty much how we do that.
Thanks, Sean. Maybe talk a little bit more about the pond that you fish in. We've seen our value stocks and smaller caps. But is it mainly in developed markets, in the US market, or is your pond broader than that as well?
Yeah, so it is good question, Eugene. So our benchmark is developed MSCI. We do have the Petrobras, which is in emerging markets. We are happy to go to emerging markets if we see great opportunities and at much lower prices than elsewhere. For example, Petrobras we think is fantastic value. We don't have any Chinese equities. Okay, we think the risks there are too high. They don't have ownership of many of the companies do not have ownership of the underlying assets. They don't pay dividends. All those kinds of factors. So we will only move outside our pond, fish in another pond, if the fish in our pond are not more attractive. But when I can buy developed, highly regulated banks on 5 and 6 times earnings, I'm not going to go and buy, an emerging market Chinese bank, for example. So, and we've got a universe of thousands and thousands of companies. So we're very, very judicious about investing outside developed markets, and we'll only do it if it makes financial sense.
Makes a lot of sense. And I mean, all this talk about China as a hedge to developed markets contracting, are there any particular stocks that you look at in the pond that you fish in that can potentially benefit from China unlocking?
Well, I guess you've got, for example, Sanmina. So what Sanmina, let me just explain what Sanmina does. They are essentially a contract manufacturer. They will assemble and design and assemble things like printed circuit boards, MRI machines, the circuitry and cables that go into airplanes, into Patriot missiles, things like that. Now, obviously, some of those products are highly sensitive, and you don't want them manufactured in the East. You want them manufactured in the West. And so they're moving and bringing the manufacturing and assembly of those onshore. And what that means is that now all of a sudden they're a price setter, okay? And it's like, I need those Patriot missile printed circuit boards made or assembled in America. Fine, this is the price, no problem. And so that's quite powerful, and that's why you're seeing their growth go up. So, there are always situations and companies that benefit from the current environment, and that's what we always focus on. For example, it's a tough economy. People are going to be trading down. We might not be buying the branded dishwashing liquid. Who cares, as long as your dishes are clean? Okay, quite happy to buy the supermarket no-name brand dishwashing liquid. Well, we've got supermarkets, Kroger, Albertsons, Carrefour, who benefit from that trend. Okay, there's that great saying, Ian se dood is 'n ander se brood. Well, we're looking for the ander se brood. And always trying to find the opportunity, saying there's a storm out there, who's benefiting from the storm?
Exactly, and buying at a discount with growth in earnings, you are definitely going to make money in those companies over time. Maybe just a quick scenario, and it is plausible. I'm not saying it's going to happen, but if central bankers were to pause at upcoming meetings, one of the upcoming meetings, to create some sort of financial stability and potentially signal the end of quantitative tightening, we could see a relief rally. And with the dollar coming under pressure again, how will value stocks perform relative to growth stocks if that scenario were to play out?
So I think that's a very good question. And I think a lot of people are busy going through that scenario in the head, because the thinking is value did well when interest rates are rising. Okay, now if the interest rates are no longer rising and in fact they're going to be falling, well, then we need to go and buy the growth companies. That is very much the thinking. Well, the first point I'd say is, remember, we did well during, we managed to do okay even though value was underperforming, all right? So the second thing I would say is that presupposes that the growth companies are still growing. And I showed you examples of the fact that they're not. And so I think everybody it's a bit like watching a rugby game and you think the ball's going to go down the back line and then the scrum half picks it up and scores next, on the blind side. Okay, so everybody's watching this back line thinking, okay, interest rates are not going to be going up, therefore it's good, we must go and get exposure to growth. And my argument is actually the problem is growth is not growing anymore. And so I don't think it's going to be the same.
Yeah.
And the other thing I would say is that with all that we've seen, the failures in the US, the Bitcoin, etc. What is the origin of those? The origin of those situations is very low interest rates. So even if the Fed pivots, right, it's not taking rates back to naught or close to naught. And so we're never going back to that. Not in my lifetime do I believe we're going back to those rates. And so therefore one shouldn't expect the growth companies to do what they did.
And if you look at monetary policy, it's a blunt tool. So it's not as if you can halt extraction of liquidity in the market at a particular point. It normally overshoots and it hurts the bigger companies out there. Maybe just a question from the audience very quickly. There seems to be mega trades such as green energy, geopolitical risks, etc. How are you assessing the future trends to get exposure to and at the same time managing the seemingly increasing risks?
Well, I guess a few points there. We are not thematic investors. But that is not our primary thing. We bottom-up investors. But when we are bottom-up investing and looking at companies, we kind of identify some trends. For example, a trend that people are not talking about, many people aren't talking about, is this increase in private label products. So in other words, no-name brands. We call it private label internationally. I don't know what we used to call it no-name brands when I was growing up in South Africa. That, I think, is a big trend. We're exposed to that. The casualization of society. People are, you don't want to be a men's suit fitter, okay, out there right now. No one's wearing suits. We're all wearing comfortable clothes. Well, Foot Locker is exposed to the casualization of society, that trend. Onshoring. Sanmina is exposed to onshoring. So within those, we've got some trends, but they're probably not the big trends everybody's talking about yet.
Yeah.
A company just because ESG and we did this is what's going to happen. I mean, you saw a lot of those wind farm companies last year. They had such demand for their products, but actually what killed them was the commodity prices. And so we would prefer to be we've got some basic materials companies. Something like Heidelberg Cement is benefiting from all the factories that are getting built in the States and in Europe in part of this onshoring. So we're exposed to those companies as well.
Yeah, it sounds really good. Maybe just a couple of comments from the audience, not starting to ask, when is the fund available? The feeder fund launched on Friday. We are busy loading that fund on the BCI system, and we will follow loading that on all the big platforms, probably the next week or 3 to get it on the big platforms. If audience out there, if there's any specific platform that you would like to see the fund on, please let us know, or your BCI BDM, let them know, and we'll try to get it on there for you as quickly as possible. There's definitely a huge demand for the feeder fund. Maybe just a last question on fees, Sean, and I know you've been in the past very explicit about fees and performance fees. You don't charge any performance fees on your fund, and what's your views on that? Why not?
Eugene, we think we want to charge a fair fee, and if our performance is partly contributed by a shift to value, well, why should we take a fee based on that? And so, I guess it's just we just want to charge a fair fee and then let clients benefit. And I know that caused a bit of chaos in financial markets. All I wanted to do was make sure people understood it. I've been in the financial markets a long time. They're highly complex. I wasn't sure everybody understood some of the complexities, and so that's why we don't charge performance fees.
Sean, thank you so much. That's all we have time for this morning. And again, from the BCI side, thank you so much for joining us this morning. And we hope to see a lot more of you and your fund in the very near future. Like I said, if I look at the chat box or the Q&A box, there's already a lot of demand for the feeder fund, and we'll communicate to our audience as well exactly when the funds are loaded. But like I said, if there's any platforms in particular that you would like to see the fund on, please let us know. We'll make sure to get the fund on there. Sean, from our side, saying thank you so much. We'll stay in touch. We'll chat to you in the very near future. To our audience out there, thank you for joining the session. You continue to support the BCI team for making all of this possible. We are truly grateful, and we'll see you again next week, Wednesday. Until then, all the best.
Thank you, Eugene.